Okay, good morning, everyone.
Morning, sir.
Good morning, good morning. So, I welcome you back again to an interesting session of ICAI on advanced financial management in CA final level. And we're going to discuss a really interesting topic today, which is security valuation. Okay, so valuation, a lot of noise around the world when we look at the valuation part. So we can be actually thinking of a lot of things getting valued in this entire globe, be it companies, be it securities, be it commodities, right? And in fact, in today's age, we have been looking at valuation for individuals also, that how valuable a particular uh, company is, or how valuable a particular person is to the company, right? So what's the whole purpose about, when we're talking of this term of security valuation? Why do we really want to get anything valued, right? Uh, so it's like simply uh, the decision that we need to take whether to invest or not to invest, whether to buy or not to buy, right? That's the whole idea why we need to carry out the valuation. So the entire world is behind this valuation aspect for a simple reason, to decide whether we should be really be investing or we shouldn't be investing, right? Whether we should buy a particular share or buy that particular debenture, or we shouldn't buy that, because that ultimately depends on the value of a particular product, right? For example, if you just go to the market and you ask the price of, let's say, 1 kilo of potato, right? And the vendor quotes it as rupees 1,000. Suppose the vendor quotes that it is 1,000, right? So in such situation, if you have 1 kg of potato as, let's say, rupees 1,000, what are you really going to do? Are you going to buy potato from that vendor, or are you going to just avoid that vendor? Yeah, guys. What will be your action? Are you going to buy the commodity from that vendor who's quoting you 1,000 for 1 kg of potato?
No.
We're definitely going to avoid it, right? Because the first thing that will come to our mind is, essentially, so this particular vendor is charging very high price, or I can say this particular term, when he's saying that 1,000 rupees, it simply means it's overvalued. And when you say that it is overvalued, you're definitely going to not buy, right? So you are like, in your conscience, you have set a particular value of potato, or you're aware what's the true value of potato in the current market situation. And that's where you say that this 1,000 is overvalued, right? Some sort of that basic fundamental is required even in the equity shares, or even in the debentures, or even in the bonds, guys, right? So for example, if I say one share, okay, so let us say one share of some XYZ Limited, okay, it's quoting at, let's say, 340. How do you decide I should invest in this particular share, or I should buy this share, or I shouldn't buy? For that, you need to compare with its fair value. So fair value of XYZ. If I say fair value of XYZ, or the intrinsic value, or the value which should be in true essence, right? Let us say that is, rupees 300. So what will be your decision? Are you going to buy this share, or are you going to invest in this share, or you are not going to invest in the share? Yeah. Are you going to buy this share, or are you not going to buy this share? What would be your
Not to buy.
right? Because it's, can I say, it's again 340. The price that we observe in the market, 340, is overvalued, right? Correct. So we're saying that this is overvalued, and rather, instead of not buying, if someone is ready to deal at it at 340, I will definitely sell the security to that person. Right? Because I know that a particular product is worth 300, but if the quote available is 340, would happily be selling that commodity, because I know in a period of time the price is supposed to be settling down to 300, right? So same way, if I just quote you, let's say, one share of some company, it's available at, let's say, 3,600, right? And its fair value, so we calculate by using some financial techniques the fair value of the share, and we find that the fair value is worth 4,500. Now, what will be your decision? Are you going to buy the share? Should we invest in this share, or we shouldn't invest?
Sir, should invest
We should invest. Why?
because fair value is greater than, sir.
Yes, the fair value is greater because we are going to pay 3,600 for a share which is worth 4,500, right? So this simply means that the particular share at 3,600 is undervalued.
Undervalued.
So this is undervalued. Now, when you say this is undervalued, we are going to buy the particular share. So when the share is undervalued, we are going to buy it. So to simply put up a simple formula, we can essentially say it like this. Fair value of asset, if it is greater than the market price. If the fair value of the asset is greater than market price, can I say it simply means that the asset is, if the fair value of asset is more than the market price, then the asset is, can I say undervalued or overvalued? If the fair value is more than the market price of the asset,
Undervalued.
This is undervalued, right? So this is a clear case of undervaluation. And when we look at the situation being undervalued, our decision is going to buy in that share or invest in that particular share. Then, coming to the other aspect, if the fair value of asset is less than the market price, fair value of the asset is less than the market price, then it is going to be overvalued.
Overvalued. And we don't buy it, sell it.
We don't buy it, or rather,
Sell
if
it.
we have an opportunity, we will sell it. Right? So now the whole idea is, depending on the discussion regarding, because market price is something that you can see in the market, right? That is what you can observe in the market. What is the value that's ongoing in that market? But when we want to really decide whether it is undervalued or overvalued, the things are not going to be only based on market price. I need to compare it with something called as the fair value. So the discussion that we are going to carry out in this particular topic is how to determine the fair value of a security. Okay, so we are going to discuss about how do we determine the fair valuation of a particular security. Okay, so how do we go about, how do we determine, what are the various techniques, what are the various statistical measures or financial measures to determine the fair value of the securities, right? So what are we really going to discuss in this particular subject or in this particular topic? First, we are going to discuss the return concepts. Basically, how do you calculate the return? Okay. Then, secondly, we are going to discuss about the valuation of equity shares. Okay. So we're going to discuss about the valuation of equity shares, in which we will definitely have multiple techniques. So valuation of equity shares, we think of dividend-based model. Right. So dividend-based model. Second, earnings-based model. Right. Then we are going to discuss about some cash flow-based model. And something called as enterprise value. Okay, so these are the things, these are the aspects that we are going to cover or that we are going to discuss in this particular part of valuation of equity shares. Then the next thing that we're going to discuss is valuation of preference shares. Okay. Followed by another crucial part called as valuation of bonds. Okay. Now, in the valuation of bonds, we are definitely going to cover two important concepts. One is about the value, calculation of the value of bond, and understanding the risk in bond. Okay, the risk in bond is going to be, we'll be discussing something called as Macaulay duration and also modified duration. Okay, so this is what is the typical agenda that we have for this particular topic of security valuation. Okay, so let us get started with certain concepts or the return concepts because that's the really crucial part that we need to understand before we actually start with the valuation of the securities. Okay, so in the return concepts, first, in the return concept, the first thing that we need is required rate of return, right? So we need to understand what's the required rate of return, because wherever we are going to invest, we obviously have an intention to earn certain returns out of it, right? So required rate of return is what you can essentially say that we are talking of the opportunity cost of capital. Okay, so that's the opportunity cost of capital. So required rate of return is what we essentially talk of as the opportunity cost of capital, that had I been not invested over here, I had put the money somewhere else at a similar risk, what's the rate of return that we would have earned, right? So this required rate of return is essentially taken to be as a discount rate. Is essentially taken as a discount rate, right? So discount rate is basically, this is the rate used. This is the rate which is used to calculate present value of future cash flows. So the rate that you're using to discount all the future cash flows to the current level. Now, can I have a same discount rate for all the assets, for all the securities, or should it be different?
It could be different, sir.
It should be different. Okay. Can I have the same rate of discounting for all types of equity shares? or every equity is going to be discounted at a different rate?
It's a different rate, sir.
It's a different rate. Why should we have a different rate for different security?
Sir, because in even equity shares have different market value, market
No,
capitalization,
that's okay.
different
They'll have
products.
different market value, but my idea is why should I use different discount rate for different equity shares?
Because different equities have different risks.
Yes. So risk of every equity share is going to be different, right? So discount rate, when we say, it actually depends on the risk. It actually depends on risk of the security, right? Which follows that higher the risk, higher will be the
Discounting rate.
discounting rate. Higher the risk, higher will be the discounting rate. Okay. So we have in fact, not only the discounting rate, even the time period of cash flow is going to determine when we should discount the cash flows. Even the time period of cash flows is going to determine which, what should be the discount rate. For example, if we have cash flows coming in first year, or in fifth year, or in ninth year, right? So let's say cash flows are, 70, then 100, 160. Do you feel that all these cash flows should be discounted at a similar rate, or should the discounting rate be different? It should be ideally different, right? Because the cash flow that is going to come in the ninth year is more uncertain than we have it in the first year. Am I right, guys? Yeah. So the cash flow which is expected in ninth year, sir, it's going to be highly uncertain as compared to the first year cash flow. So therefore, here the discounting rate is going to be definitely different. So let us say the discounting rate in first year, it is 7%. In fifth year, it is 10%. And in ninth year, it's, let's say, it's highly, very much at a longer distance. So we can say it will discount it at a higher rate at 16%. Right? So can you help me with the present value factors at this rate? Can you tell me what will be the present value factor of the first year cash flow? What will be the present value factor of the first year cash flow?
0.935.
0.935. Yeah. So it's like 1 divided by 1.07, which is 0.935. Then 1 divided by 1.1. But this has to be taken for 5 years. So first year, second year, third year, fourth year, fifth year. That's 0.621. Right? And then 160, 1 divided by 1.16. That's going to be for 9 years. So 1, 2, 3, 4, 5, 6, 7.
263.
That's 0.263. And then, of course, we can simply take the PV by multiplying them with the cash flows, and then we arrive at the value of that security, right? So the idea is you can have multiple discounting rate for multiple cash flows because they are having different risks, and even the time period can be different, right? Okay, another thing that we have already learned at inter level was something called as internal rate of return. Internal rate of return, or IRR, right? What is this IRR, by the way? Can anyone recall what was this concept of IRR? What was the concept of this IRR? Yeah? What was this IRR? IRR was essentially the rate of return earned by investor. Rate of return earned by the investor. Like the investor is going to invest some money and is going to realize certain cash flow out of it, and the rate that the investor is earning what we call it as the internal rate of return, or IRR, right? So here, let us say, for example, we make an investment of 1,000, right? And we sell the security for a price of, let's say, 1,200 in year one. So let's say investment is 1,000 and the sale price is 1,200 in year one. Okay. So can you tell me what's the rate of return that we have earned? What's the rate of return that we have earned?
20%.
20%.
Right? So that's 20%, right? Because it's just 1 year, so you say it's 20%. Now, one more thing that we have learned is that at IRR, NPV of the particular project or NPV of that particular asset is going to be, when you discount the cash flows at IRR, NPV becomes how much? 0, right? Am I right? Because at IRR, your present value of cash inflows is equal to present value of cash outflows.
Yes, sir. 0, sir.
Yeah. So if I just try to calculate, let's say NPV at a discount rate of 20%. So we have here cash flows, PV factor, and then PV. So year 0, you're paying 1,000. Present value factor is 1 and PV is going to be 1,000. Then year 1, you're receiving 1,200. So let's say PV factor at 20%. How much is the PV factor by 20%? 1 divided by 1.2, which is 0.8333. You'll get the PV to be 1,000. And that essentially makes the NPV as 0. Okay, so with this, we can definitely say IRR is the rate which is earned by the investor. It is also the rate at which the NPV turns out to be 0. Okay. Now coming to the equity shares part, required return on equity. So we're talking of required return on equity. How much would an equity shareholder require from a particular share base? On what factor is the required return going to be dependent on? Can I identify the factor on which the required return is going to be dependent on? Yep. Yeah, guys.
Amount of dividend which will be received by the investor.
No. How much return do you require? That's not dependent on the dividend, because dividend what you get will be the actual return that you get. I'm not talking of what return you are getting. I'm talking of what return you will require. Can I say the required return on equity? Again, as we have said, it depends on risk. It depends on the risk, guys. So required return on equity is essentially going to depend on the risk, right? And for that, we have a very popular model called as capital asset pricing model. Or what we call it as CAPM. Capital Asset Pricing Model, or CAPM. So do we remember the formula for this capital asset pricing model?
Yes, sir.
We calculated to be
RF,
plus
plus
beta
beta
into
RS minus RF.
RF, right? Okay, what was this RF?
Risk-free return.
RF is the risk-free rate of return, right? The rate of return which you earn on the risk-free securities, right? Then what was RM?
Market risk.
Market risk? No, it's the return on market portfolio.
Market return, sir.
It's the return on market portfolio. What about beta? Beta was essentially a measure of
Risk.
systematic risk.
Systematic risk.
So beta is a measure of systematic risk. So what do you mean by systematic risk? It is actually a measure of sensitivity. It's actually a measure of sensitivity of security with respect to market. Right? So that's the sensitivity of the security with respect to the market. Now, what do we mean by sensitivity of security with respect to the market? It simply means that, for example, if beta is 2, what does this mean? It simply means that security is twice as risky as market. So whatever is the risk in the market, the security is double of it. Security is having the risk double of that. So obviously, if the security is having double risk than the market, then whatever return you get extra in the market in beta, it should be double of that. So for example, if I say that risk-free is 6%, market rate of return is 10%. So what is the extra return that you're getting by investing in the market? If the risk-free is 6%, return on market is 10%. What is the extra return that you're getting?
4%.
4%, right? And now if I say that beta is 2, so beta is 2 means my security is having double risk that of the market. Can I say beta into RM minus RF, which is 8% is the return that you will require? Right? Correct?
Yes.
So 8% is the return that you will need from that particular security. Yeah, I mean 8% is the additional return or the risk premium that you will need from the security. Right? And therefore, we essentially say that the return that we will require is definitely 6% plus the additional risk premium, extra return of 8%. So I should get a total return of 14% from my security because of the higher risk involved in it. Okay, so I just try to give you a brief idea about CAPM. More about it, we are going to definitely discuss in the chapter of portfolio management. Okay, now with these return concepts clear, let's try to go ahead with the another aspect, which is, or the next important part, which is the valuation of equity shares. So there are different approaches to that. We'll take up one by one. So valuation of equity shares. Now, there are different approaches depending on what is your holding period of the equity share, right? So first aspect that we're looking is if holding period is 1 year. So if holding period is 1 year, so if the holding period is 1 year, we can say that expected cash flows. What are you going to expect from that particular security, guys?
Dividend.
Dividend. And after 1 year, what are you going to expect?
Terminal value.
Price.
Terminal value. Or can I say the price of the share after a year?
Yes, sir.
Right. So expected cash flows are going to be D1 and P1. So D1 is, let's say, 12, and P1, that is the price at which the share is going to sell, that is, let's say, 60. Right? And you need a return based on CAPM, let's say KE is 12%. So if I ask you, what should be the value of share for you? What should be the value of share for you? value of share should be nothing but, sir, present value of cash flow 1, because you're going to hold it for just 1 year. You're going to just hold the share for 1 year. So value of the share is going to be simply present value of cash flow in year 1. Right? It's going to be just present value of cash flow in year 1. So what is going to be the present value of cash flow in year 1?
64.29.
Can I say it's going to be like you will receive 60, you'll also receive this 12, and we want to take the present value of it. So present value of this is going to be 1.12, which is 72 upon 1.12. Right? So you can just give me the value of it. How much is it?
64.29.
64.29.
29.
Perfect. So can I simply say that the value of share is nothing but D1 plus P1 upon 1 plus K. Right? So value of the share, if your intended holding period is just 1 year, it's going to be just D1 plus P1 upon 1 plus K. Makes sense, everyone? Right? But then if you don't know for what time period you're going to hold the share, or I can say if your intention to hold the share is not for certain foreseeable future, but for certain period which you don't know, it's like you're going to hold it for a till the company is going to be there, right? Then we need to have a different approach, right? So we're looking at the second case wherein the valuation is based on multiple holding period. Okay, so valuation based on multiple holding period. So first thing that we can think is, let's say there is no growth. I mean, the same amount of dividend is, let's say, being paid out to you. So what should be the value of the share? Right? So if you're saying that there is no growth going to happen, if your intention is, to have no growth in the dividend, then it's like you're going to get the same amount of dividend till perpetuity. So first year dividend, you discount it for 1 year, right? Second year dividend, you discount it for 2 years. Third year dividend, you discount it for 33 years, and then it just goes on till perpetuity. Okay, so if you can just think this off, this is like a geometric progression.
Normal.
This is a geometric progression wherein the first term is d upon 1 plus k, and the multiple is 1 upon 1 plus k. Right? So d upon 1 plus k, and return is going to be 1 upon 1 plus k. And summation till infinity, the formula is what? A upon 1 minus r. You might have learned this in your foundation level quantitative techniques, right? So summation till infinity is a upon 1 minus r. So if I just apply the same formula here, so a is dividend upon 1 plus k upon 1 minus r is 1 upon 1 plus k. Okay, so this is going to be equal to dividend upon 1 plus k, the whole upon 1 plus k minus 1 upon 1 plus k. So from this, we can definitely say 1 plus k gets cancelled. And what we have essentially left is dividend upon k.
K.
Right? So if there's no growth, we can definitely say value of the share today is going to be dividend upon cost of equity. Simple. Correct this?
Yes, sir.
Yes, sir.
So this was where we don't have any growth. Now, another model could be, you have a constant growth in dividend till perpetuity. So you are having constant growth till perpetuity. When we're saying we are having a constant growth till perpetuity, value of share is going to be equal to, of course, the same logic that we have. The first year dividend discounted at 1 plus K. Then the second year dividend is going to witness some growth in it. So it's going to be dividend into 1 plus growth. And then you discount it by 1 plus K square. Then the third year dividend is D1 into 1 plus growth square upon 1 plus K cube. And then this goes on till perpetuity, this infinity. Now, again, does this seem to be like a geometric progression to you? Does this seem like a geometric progression to you guys?
Yes, sir.
Yes. Okay. So this is
Discounting
again a
every
geometric
year.
progression wherein the first term is d1 upon 1 plus k, and the multiple that we have is 1 plus g upon 1 plus k. Right. So value of share, we can say it's d1 upon 1 plus k plus d1 into 1 plus g upon 1 plus k square plus d1 into 1 plus g square upon 1 plus k square. That goes on to infinity. So it's acting like a geometric progression. Right? It's again acting like a geometric progression. So here, again, the summation till infinity formula is a upon 1 minus r. So if it's a upon 1 minus r, it's going to be d1 upon 1 plus k, the whole divided by 1 minus 1 plus g upon 1 plus k. So I'm just substituting a and r in this particular formula. Okay. So summation till infinity, we can simply calculate this as d1 upon 1 plus k divided by 1 plus k minus 1 minus g upon 1 plus k. Okay. So 1 plus k gets cancelled. 1 and 1 gets cancelled. So that's d1 upon k minus g. Right. So that's the formula that which we have, d1 upon k minus g, which is what we talk as the value of the share today. Right. So we've got two formulae. One is dividend upon k if there's no growth. If there's a constant growth happening till perpetuity, then you have d1 upon k minus g. And this particular formula is also said to be of Gordon's model. So there was this guy, the Nobel Prize winning guy Gordon, who has derived this particular formula of d1 upon k minus g being the value of the share with a perpetual growth. So this is going to work, this particular constant growth rate is going to work like, for example, here. Or we're going to talk of a dividend. So let's say in first year, the company paid you a dividend of 10. Then second year, it paid you a dividend of 11. Third year, it's going to pay a dividend of 12.1. Fourth year, it's going to be 13.31. So can you identify what's the growth rate over here? What's the growth rate in dividend in this case?
10%.
10%. So every year, the dividend is going to grow at 10%. Every year, the dividend is going to grow at 10%. But you know what? This formula of value is equal to d1 upon k minus g. This particular formula is a bit of problematic, guys. It's a bit of problematic. Can you identify some problem, some difficulty with this particular formula, d1 upon k minus g?
Yes, sir. If that growth is higher than the K, then that
Perfect.
value will be turned into negative.
Yes. If your growth is greater than ke, or even if your growth is equal to ke, can I say V0 will be absurd? Either you will get an infinity value, right? Or you are going to get the value which is, negative, right? So very high growth rate, if you take into consideration over here, this formula fails to give you an appropriate answer. And that's where the thought process came up, with regards to variable growth rate, right? Instead of taking one single growth rate for the lifetime of the company, it's actually, more sensible to take a cognizance that the company cannot grow at a very high rate forever, right? So, for example, if we have, let's say, the dividend, or let's say the D0 we have. So D0 is, let's say, 10 rupee. Okay. And then I say that the growth rate is 20% and the cost of equity is 12%. D0 is 10, growth rate is 20%, and cost of equity is 12%. So if the growth rate is 20%, if your cost of equity is 12%, can you tell me what is going to be the answer for this? Are we going to get some realistic value, or it's going to be absurd value? Of course, it's going to be absurd value. We will be getting the value as a negative, right? And then the logic comes in, sir, are you very sure that the company is going to grow at 20% forever till perpetuity? Does it sound realistic to you guys?
No, sir.
Does it
Does
sound
not
realistic
sound
that,
realistic. No, sir.
that the company is going to grow 20% every year, sir? The GDP is growing at 5%, 4%. How come you are able to grow at 20% forever? Is it going to really be happening that way? No, it's not realistically possible. So ideally, you will say that this high growth rate, a very high growth rate, or a super growth rate, the company is going to enjoy the benefit of super growth rate for initial few years when the product is new, when the company is new, when it is experimenting, when it is, in the nascent stage, when it is in the developing stage. After a point of time, what is going to happen, guys? Can you see the growth rate needs to normalize to a lower level? Right? So this 20% growth will say that this is going to be there for, let's say, 3 years, right? And which is a high growth rate. Okay, 20% growth rate is going to be for 3 years, which is going to be a high growth rate. And then we have 10% growth rate for 4 year onwards. Right? And this is your normal growth rate. Normal growth, or you can say the stabilized growth rate. So stabilized growth rate or normal growth rate is going to be from year 4 onwards, which is 10%. Right, guys? So we can definitely think it from that point of view that it's not true that every time growth rate is going to be higher than the cost of equity, or you cannot be very sure that the growth rate is going to be extremely high forever. And therefore, we came up with this concept called as two-stage dividend discount model. So we have two-stage dividend discount model. Okay, so we're having two-stage dividend discount model. So there are 2 stages in which the dividend is going to grow. The dividend is going to be growing at 20% for 3 years, and after that, it's going to grow at 10%. Okay, so if you simply think of the cash flows that we are getting, it's going to be till perpetuity. So we have year 0, year 1, year 2, year 3, year 4, year 5, year 6, and it just goes on till perpetuity, right? So if I ask you the dividend in first year, can you tell me what will be the amount of dividend in first year?
11.
Dividend in first year is going to be 12, guys, because it's simply going to be 10 into 1.2, right? So 10 into 1.2. Then what about dividend in second year?
14.4.
Can I say it's going to be 12 into 1.2, which is 14.4. Dividend in year 3, it is D3. That's going to be 14.4 into 1.2 again, because
1.2.
17.28.
17.28. Then in fourth year, it's going to be 17.28 into 1.1.
18.38.
18.38.
Yes, sir.
Then in year 5,
20.218.
20.2122, right? 218. And then in year 6,
22.24.
24. So this just goes on till perpetuity. So now when I want the value of the share standing in year 0, can I say it's just going to be the present value of all of this, right, guys? It's just going
Yes,
to be
sir.
present value of all of this.
Yes, sir.
Right? So value in year 0 is just going to be present value of all of this. Right? So value in year 0 is going to be present value of all of this up to the year 0 level. Now, how do we get this present value? That is the real challenge that we are talking of. That's the real challenge that we are essentially thinking of. Because I cannot apply the Gordon model over here. Because when we say value in 0, the growth rate has to be constant. But here, the growth rate is varying. You have a growth rate in this batch, right? There's one day growth rate. And then from the next year onwards, the growth rate is different. Right? So for the initial years, you have a growth rate of 20%. Then later on from year 4 onwards, you have the growth rate, which is at the rate of 20%. So here the growth rate is 20%. And here the growth rate is 10%. Sorry, my bad. So here the growth rate is 10%. And here we have the growth rate as 20%. So how do we go about valuing this? So what we essentially do is, let's try to get the value of the company in year 3. The value of the company in year 3. Just like we had the formula of value in year 0 is D1 upon K minus G, under an assumption that from D1 onwards, all the growth rates are going to be constant. Same way, can you tell me what should be the formula for the company? Let's say I want to value the company in year 3.
D4 upon KE minus G.
D4 upon KE minus G. And why have we taken value in year 3? Because after year 3 onwards, your growth rate is becoming constant at 10%. right? Because after year 4 onwards, or after year 3 onwards, which is from year 4 onwards, your growth rate is becoming constant at 10%. And when we say that the growth rate is constant at 10%, okay, when the growth rate is constant at 10%, that's where we can actually calculate the value in year 3. So can you tell me what will be the value of the company in year 3? We know what's the D4, right? Fourth year dividends. Fourth year dividend is 18.38 upon KE is how much?
12%.
What is KE?
Cost of equity.
Cost of equity. So what was the cost of equity? Let us say the cost of equity was 12%, right?
Yeah, it mentioned as a 12%.
12%. And the growth rate is 0.1. So what's the value of the company in year 3?
$919.
919.
Yes, sir.
So 919, this is what we call as the terminal value of share in year 3. This is the terminal value of share in year 3. So value in year 3 is 919, and we have the terminal value of the share in year 3. Right. So 919, this is the value of the share in year 3. Can I say this is essentially 919 is nothing but it's the value of the share in year 3, which is nothing but it is essentially present value of all cash flows from year 4 till year infinity, right? Bought to year 3 level. So 919 is the present value of all cash flows from year 4 till year infinity, which is bought to the year 3 level.
There is the value of dividend taken above from 4 years above is correct. I am getting something else, sir.
You're getting something else? This is
Yes,
not
sir.
that number. 17.28 into 1.1.
It's
Yeah, that's actually
19.
19. Yeah, the number is different. This is 19, guys. Who said me this 18.38? This is 19. Then, in fact, these numbers are also going to change.
20.9.
Sorry, 20.91. 20.91. Then
22.9.
22 point.
23.01.
Okay, 23. Okay, then we can definitely say the value of the company in year 3 is going to be 19 upon this, or this is, can I say 950?
Yes, sir.
Yeah. So this is the terminal value of the year 3, wherein what we have essentially done is we have bought these cash flows. Okay. We have bought these cash flows up to year 3 level. We have taken it to year 3 level. We have taken it up to year 3 level, right? So we have taken all these cash flows in present value terms to year 3 level. So we have bought it up to year 3 level. All the cash flows that we have bought it up to year 3 level. Okay. Now, since all these cash flows are brought up to year 3 level, this is not actually the value of the share today. So if I want the value of share to be calculated today, how do we go about calculating the value of share today? So value of share today is simply going to be dividend that we are going to get in the first year, dividend that we are going to get in the second year, plus dividend that we are going to get in the third year, and also value of the share in year 3. Value of the share in year 3 upon 1 plus KE Q. Right, so D1, D2, D3. So you have like 3 dividends divided by 1 plus K, 1 plus K square, 1 plus K cube, and also the third year. So essentially, if you're going to buy the share today, you will be getting dividend in first year, dividend in second year, dividend in third year. And also if you're going to sell the share in third year, you'll be able to sell it at a price of 950. So today you're going to pay the price for all the future dividends that you're going to receive and also the value that you're going to receive. So essentially, over here, the value of the share is going to be, we can simply do it this way. Year, particulars, right? Cash flow. PV factor is, let's say, 12%. And then we take a PV. So in year 1, 2, and 3, we get the first year dividend, the second year dividend, and third year we have like D3 plus the value of the company in third year. So cash flows are like you get 12, you get 14.4, right? And the third year cash flow is going to be the dividend of 17.28 and 950. So which is 967.28. So let's take the PV factor at 12% because I'm going to discount all the cash flows. So 1 divided by 1.12, that's 0.8929, 0.7972, and third year it's going to be 0.7117. So present value is equal to 0.8929 into 12, which is 10.71, then 0.7972 into 14.4, which is 11.48, 967.28 into 0.7118, which is 688.51.
Total 710.70.
Sorry? 10.71 plus 11.48 plus 688.51. So total comes out to be 710.68.
70.
This is what is the value of the share today. So when we want to take the value of the share at differential, growth rate, this is what we are going to approach. Are we clear with this approach, guys? The two-stage dividend discount model. Are we good? Two-stage dividend discount model, guys?
Yes, sir. Clear, sir.
Yes.
Yes. Okay, perfect. So I think we are now in a position to probably solve one of the questions. Yeah. I want you to try out this question number 13. Would you like to try it first, guys?
Yes, sir.
Yeah. This is similar to what we discussed just now. Yeah, so I'll just place the question over here. Yeah. So here we have the question. And I want you to just give it a try and tell me what's the value of the share. Tell me what. Solve it in the similar way they did in the previous one. Try to solve it, guys, quickly.
Sir, my question is, 4 dividend is D0 or D1, sir? Onwards means?
It has declared, right? You say
Okay.
it has declared. If it has been paid, it's D0,
Okay, sir,
right?
fine.
Or if the question said it is expected to pay, then it's going to be D1.
V0 equal to 104.35.
So value is coming out to be 104.
Yes, sir.
Okay. Okay. Fine. So here, let me just quickly solve it. D0 is 4. And then we have growth rate is 20% and 10%. 20% is going to be there for 2 years, right? And this is year 3 onwards. Okay. Then we have year and the dividend. So year 1, we have 4 into 1.2. So dividend is 4.8. Second is 4.8 into 1.2, which is 5.76. Third is 5.76 into 1.1, which is 6.336. Then we get the value of the company in year 2, which is D3 upon K minus G, wherein the D3 is 6.336 upon K is 0.15 and this is 0.1. So this works out to be how much?
126.72.
126.72. Right. Then we take year 1 to cash flows. Year 1 it is 4.8, year 2 it is 5.76 plus 126.72. So this comes out to be what? 126.72 plus 5.76, 132.48. Then we take the present value factor and the present value. So if we take a total of it, this works out to be how much, guys? 104.35, the value of the share.
Yes, sir. 104.37.
3735. That's okay. Okay, so we are done with this question 3. Now, similar question we have is this question number 5, guys. Let's try to solve this question 5 first. So question 5, we have got X Limited just declared a dividend of rupees 14 per share. Now, Mr. B is planning to purchase the share of X Limited, anticipating increase in growth rate from 8% to 10%. Okay. So we have X Limited, which is declaring a dividend of rupees 14 per share. And there is one Mr. B who is an investor who wants to purchase the share. And, it is anticipating that the growth rate is going to be from, increase from 8% to 9%, which will continue for 3 years. So the high growth rate of 9% is going to be there for 3 years. He expects the market price of the share to be 360 after 3 years. So he's clearly stating that after 3 years, the share price is going to be 360. You are required to determine the maximum amount Mr. B should pay for shares if he requires a rate of return of 13% per annum. So this is one part of it. Then the second part is the maximum price Mr. B will be willing to pay for the share if he is of the opinion that 9% growth can be maintained indefinitely and require 13% rate of return per annum. Okay, the maximum price Mr. B will be willing to pay for the share if he is of the opinion that 9% growth can be maintained indefinitely and it will require 13% rate of return on a per annum basis. Okay, so 13% rate of return on a per annum basis, this is what we are looking at. Right, so 9% is indefinitely and 13% is a KE. This is a separate way of valuing it. Then the price of the share at the end of 3 years, if 9% growth rate is achieved, and assuming all other conditions remain same as in 2 above. Okay, so let's answer it one by one. First, maximum price that we should be ready to pay if the required rate of return is 13%. Guys. So if the required return is 13%, we are simply talking of KE will be equal to 13%. Right, the maximum amount Mr. B should pay for shares if he requires a rate of return of 13%. Then the growth rate increasing from 8% to 9%. So growth rate is 9%. Okay. Then B is planning to purchase the share of X Limited, anticipating increase in growth rate from 8% to 9%. And he expects the price of the share to be 360 after 3 years. So basically, terminal value or value in year 3 is already given to us as 360. Okay. And the dividend that was paid is 14. Now, of course, to get the value of this share, we need to do some sort of further calculations. So essentially what we do is we write down the year, the cash flows, PV factor, and the PV. So year 1, 2, 3. Cash flows are going to be like first year. What is the cash flow going to be, guys? Tell me. Dividend was 14. So 14 into 1.09.
15.26.
Okay. 15.26.
Then 16.6334.
Then it's going to be 15.26 into 1.09, which is
16.6334.
16.63.
63, 63. 16.6334.
Into 1.09 plus 300. Oh, sorry, 360. My bad. 360. So what's the cash flow in third year when we will sell the share along with the dividend?
388.13.
388.
Yeah, 360.
I don't have
378.
faith. I don't have faith on your numbers now because you have betrayed me once.
Sir, 378, sir.
Yeah. It's 378.13.
378.13.
Okay. So these are the cash flows that we have. Now we can definitely take the present value factor at 13% and then take the PV. Give me the PV, guys. Calculate the present value.
$288.57.
How much? 288 point?
288.61, sir.
288.57. Okay. So it depends what PV factors you have taken. If you just take the PV factors to be at 13%, these numbers 0.885, 0.783, 0.693, then I think the answer should be 288.57. Okay, some rounding up thing is okay. That's the first part of the question. Now the second part says, what is the maximum price we'll be willing to pay if he is of opinion that 9% growth rate can be maintained indefinitely and he requires a 12% rate of return. Sorry, 13% rate of return. So which model are we going to use for the second part of the question?
Growth, yes, sir. No growth.
Which model? Constant dividend growth rate, right?
Yeah, constant growth, still perpetuity. D1 divided by K. Yeah.
Constant growth rate. So what is the constant growth rate? Constant growth rate of 9%, right? So when we have the constant growth rate of 9%, we have V0 is D1 upon K minus G. V0 is going to be D1 upon K minus G. So D1 is 15.26, right? Upon 0.13 minus 0.09. The value works out to be
381.5.
Yes, sir. 381.5.
381.5. Okay. Then it further says, what will be the price of the share at the end of 3 years if 9% growth rate is achieved and assuming all other factors remain the same? So if it's going to be like 9% growth rate is going to be there, So what is the value of the share in year 3? Value of share in year 3. Which is value in year 3. That will be equal to D4 upon K minus G. And we know D4 is nothing but the third year dividend into 1 plus G upon K minus G. Third year dividend upon 1 into 1 plus G upon K minus G. So the third year dividend was anyway 16.63 into 1.09. So it's going to be further multiplied by 1.09 upon K is 0.13 minus growth rate is 9%. So what's the value of the share in year 3? Yeah, guys, what's the value of share in year 3?
$493.95.
How much is it?
93.95.
493.
Yes, sir.
It's going to be 16.63 into 1.09 into 1.09 divided by 0.04. 493.95.
Yes, sir. 493.95.
Okay. Perfect. Okay. Are we done, guys?
Yes, sir.
Yeah. Okay. 493.95. That's the part 3 of the question. Then we have question 5 is done. Okay. Let's go for the next one. This question number 6 now is. So here we have Piyush Lunkar and Associates. So it's a company basically which is paying a dividend of 1 rupee per share and has a share price of rupees 20. If this dividend is expected to grow at 12% per annum forever, what is the firm's expected or required return on equity using dividend discount model? So see, we have the price given to us and we want to know what's the return on equity using the dividend discount model. Right? That's pretty simple because we know it's going to be P0 is equal to D1 upon K minus G. So wherein we know the price is 20. So price 20 will be equal to D1. D1 is presently pay of dividend of 1. So if it's presently paying a dividend of 1, the D1 is going to be how much? Growth rate is 12%, right? So 1 into 1.12 upon K is something that we want to calculate and the growth rate is 0.12. Right? So can you solve it and give me the value of cost of equity here, guys? Yeah. Prithviraj is asking, sir, probably we discounted D5 instead of D4. Please clarify. Wherein? No, it is D4 only because 16.63 into 1.09, that was D3. And then you multiply it with 1.09 to make it D4. Got it? Prithviraj. Because 16.63 was the dividend of year 2, Baba. So it needs to be multiplied 2 times with 1.09 to get the D4 value. Okay, so over here, this question, what's the cost of equity, guys?
It's 17.6, sir.
Okay.
Percent.
17.6%. That's the key. Okay, coming to the second part. Now, the second part says, instead of this situation in part 1, suppose the dividends are expected to grow at a rate of 20% per annum for 5 years and 10% per annum thereafter. Now, what is the firm's expected or required return on equity? Now, this is something which is challenging. Now, the question says that the price is 20. The dividend is expected to grow at 20% per annum for 5 years and 10% thereafter. Tell us what is the firm's expected rate of return. Can anyone tell me how do we get this answer? Can anyone tell me how do we get this answer?
From equation type, then we have to solve.
Equation type? No. You can't solve that equation essentially because it will be an equation which is going to be raised to 5. So it's not something which can be solved easily.
Sir, dividend the year 1 is given as 1, then we can find out what it is a dividend for year 5.
Then remember, we have to find out the cost of equity to ensure that the price remains as 20. To find out the cost of equity to ensure that the price remains as 20. Anyone? Any idea? How do we go about it? No? Okay.
Sir, as we have
Sorry?
in first question taken
Yes.
K, from
Geet.
K we can proceed and growth rate.
Geet has answered maybe IRR. Absolutely correct by using interpolation method IRR, guys. Okay. So let us assume a particular rate. Let's say, suppose the cost of equity is, let's say, 20%. Now, how do you get to know that we have to use 20%? Because we got the K as what, 17.6%. So let's play around with,
We will
K
try
of
with 18. 18 we can try.
18, or let's keep it as 20. Then we can definitely work around that also. So let K is equal to 20%, right? So if K is 20%, I'll give you certain facts. Let's say D0 is 1. Okay. Growth rate is 20% and 10%. Two situations given. 20% per annum for 5 years and 10% per annum thereafter. So 20% for 5 years and 10% for year 6 onwards. Okay. So this is the data that we have. K is 20%. Dividend in year 0 is 1. Growth rate is 20%. And normal growth from year 6 onwards is 10%. Okay. So D0 is 1. Growth rate is 20% and 10%. Super growth rate from year 1 to 5. And 10% we have it. Okay. Now, can you obtain the value of the share over here? First, what we need is year, particulars, then cash flows, present value factor at 20%, then you take the PV. So you have your 1, 2, 3, 4, 5. Right. So particulars you'll have like dividend 1, dividend 2, dividend 3, dividend 4, dividend 5, plus price in year 5. Right. So we need to first calculate the price in year 5 also. So price in year 5 will be obtained as dividend 6 upon KE minus G. Okay. So D6 upon KE minus G. So it's going to be D6 upon KE minus G. So you can just write down these cash flows, take the PV factor at 20% and take the PV. And then you have to give me this particular number. Can you do it, guys? At 20%, can you calculate the present value?
Yes, sir.
Yes. Yes. So just write down the cash flows. Like first cash flow is going to be what? 1 into 1.2. So first cash flow is 1.2. Second cash flow is 1.2 into 1.2, which is 1.44. In this way, write down the cash flows.
1.728.
Sorry.
Like that. Third year, 1.728.
Okay, you can just write it. I'll write down the cash flows. Okay, 1.73, then
Then 2.07.
okay,
2.49.
okay, to 2.49 plus. In fact, D6 is going to be 2.49 into 1.1 upon K is 0.2 minus 0.1. So 2.49 into 1.1.
That it is coming 2.74.
Upon 0.1.
Yes, sir.
2.74 divided by 1 point divided by 0.1, which is 27.4. Right. So it's going to be 2.49 plus 27.4. This is 29.89. Okay. So just multiply it with the PV factors at 20%. Take the PV factors up to 3 years. 3 decimals. Okay. And then give it the PV, because we want to ensure that the PV comes out to be 20. Let's observe what are these numbers.
Sir, it's coming 16.01, sir.
16.01.
Yes.
Okay. So this is the value at a KE of 20%. Right. So definitely we want the value to be, more than 16, because the value currently that we are looking at is 20. Right. So we want the value to be 20. So if the value is to be 20, we'll have to take some other number. Okay. So let KE is, suppose, 18%, or let's keep it 16% also. Let KE is 16%. So here in this case, dividend is 1. Growth rate, the story remains the same, 20% and 10%. So 20% for 5 years. And this is for year 6 onwards, right? So using these all particulars, give me the price of the share, guys. Can we do this? Similar line. Can you do this, guys? At 16%.
Yes, sir. Only the cost of only the PV
Only the
factor
cost of
only will be
capital. Yeah,
changed.
PV factors are going to change. Yes. There's a change in PV factors. Give me the price.
18.58.
How much?
18.58.
Yes, sir. It's coming 18.58. 59.
18%.
Yes, coming 18.59 only.
At 16%, 18.59. No. Value of the share. No, I don't think so. It should be pretty higher value.
45.65.
45.
No, it's not 45.
Mm-hmm. So cash flows are like 1.2, 1.44, 1.73, 2.07, and this will be 2.49 plus. I mean, the value is value in year 5 is also going to be different, by the way, because P5 will be 2.49 into 1.1 divided by K 16%, right? So 0.16 minus 0.1.
45.65.
This is 45.65.
Yes, sir.
So plus 45.65, and then you take the PV factor at 16%, and then you take a PV.
27.23.
27.23.
23.
27.23. Just check, guys. 27.23. Yeah. So we have got KE.
Yes, sir,
And the prices.
27.23. I missed to add that 2.49.
So when KE was what 20%, price in year 0 will be 16.01. And when we made it at 16%, this is 27.23. So KE is going to be reduced by 4%. Then P0 is 16.01 minus 27.23. So this has increased by what? 11.22. So the value that we wanted this to be increasing is by 3.99. So what should be the change in KE? Change in KE will be 3.99 into 4%, right? Rather into minus 4% upon 11.22. 3.99 into 4 divided by 11.22, which is 1.42 negative, right? 1.42 negative. So 1.42% rather negative. So KE or the actual cost of equity will be 20% minus 1.42%. So which is 20 minus 1.42. That's 18.58%.
58.
Yes. That's the cost of equity, 18.58%. So at 18.58%, we can essentially say that the value comes out to be 20 as given in the question. Okay.
$3.99 कैसे है सर?
3.99. Yeah, so we wanted to make it from 16.01 to 20, right? So it's like we wanted to make it to 20 from 16.01. So the change that we wanted in the price was by only 3.99. Got it?
Okay.
Yeah. So we wanted to increase it from 16.01 to 20. So we wanted a change of 3.99. And for that, what should be the change in KE that we were essentially looking for? Okay. Yeah. And so you can also solve it by IRR formula. It will also give you the same answer. Right? So because I generally don't use that IRR formula because it's quite messy to get the high value, low value, and then all those rates. You'll get the same answer. You just need to use this 20%, 16.01, 16%, 27.23, substitute it, and you'll get the answer. No issues in that. Okay, so that was this particular question number 6. Now let's look at some other models. Okay, some other models that we have, which are also called as earnings-based model. So earnings-based models. That's again for valuation of the equity shares itself, but these are the earnings-based model. So again, we just have the Gordon formula, okay, but we're just going to redraft it a bit. So we're having the Gordon model, okay, and through this Gordon model, we can definitely say that P0. We know that Gordon model, P0 is going to be D1 upon K minus G, right? But essentially this D1, I can say it is earnings per share of the first year multiplied by dividend payout ratio upon K minus G. Okay. So Gordon formula, P0 is equal to D1 upon K minus G, so which is EPS 1 into dividend payout ratio. Okay, so EPS 1 into dividend payout ratio, which is EPS 1 into dividend payout ratio is going to be 1 minus B, which is the, the retention ratio essentially. B is the retention ratio, right?
Yes, sir.
Upon,
Blowback.
right, K minus G. Right. So this is again the price formula wherein we are not talking of dividend, but we are essentially talking about the earnings. So B is retention ratio. G is B into R. Okay, which is the retention ratio into the return on investment. So R is return on investment. Okay, this is again a Gordon model, but we are just redrafting it a bit, right? So for example, if we have earnings per share of the next year as 10 and the dividend payout ratio is 40%. So how much is the retention ratio?
60%.
Can I say 1
Sir.
minus dividend payout ratio, which
Yes,
is
sir.
1 minus 0.4, which is 0.6, right? And that will give us the dividend of first year to be equal to what? 10 into 40%, which is 4, right? And this is nothing but EPS 1 into 1 minus B. EPS 1 into 1 minus B, which is 4 rupees. D1 is 10 into 40%, which is 4. So EPS is 1 into 1 minus B. Okay. So using this formula, we can definitely get the price of the share as EPS into 1 minus B upon K minus G. So EPS into 1 minus B is 4. And let's say the K is 10%. Then the growth rate, we can calculate the growth rate as B into R, which is B is 0.6. And let's say the return on investment is going to be 12%. So this is 4 upon 0.1 minus 0.6 into 0.12, which is 0.072. So 0.1 minus 0.072, which is 4 upon 0.028. So 4 divided by 0.028. Answer is 142.86. Right? So that's how the earnings-based model work. Again, Gordon formula, just a redrafted model for that. Another way of obtaining this share prices, you might have learned it in dividend decisions, something called as Walter model. Do you remember? In CA Inter Walter model. Yeah, guys. Do you remember the Walter model from CA Inter?
Yes.
That was P0 is equal to dividend plus earnings minus dividend into R upon K, the whole divided by K. Okay, so dividend plus earnings minus dividend into R upon K, the whole divided by K. So P0 is dividend plus earnings minus dividend into R upon K, the whole divided by K. That's the Walter model. Okay, Walter model, dividend plus earnings minus dividend into R upon K, the whole divided by K. Apart from this, we have another earnings-based approach called as the P multiple approach. Now, what is this P multiple approach? Let's try to understand. Let's say there is a company X which we need to be valued, and there is the industry numbers which we have. So we talk of earnings per share and the market price per share, and then the P ratio. So in the industry, there's a leader. Let's say industry leader is having a earnings per share of, let's say, 3.5. Okay, so earnings per share, or let us do one thing. We have got three companies, X, Y, Z, and let's say company ABC. So we want to value this company ABC, and in the industry we have got three different companies. So there is in company X which is having, let's say, 2 as the EPS, company Y which is having 4 as the EPS, and company Z which is having 2.5 as the EPS. Their market prices are, let's say, 25, 44, and 30. So can you tell me what will be the P numbers, price to earning ratio of each of these companies?
Sir, EPS divided by MPS.
So MPS divided by EPS, right? So 12.5 will be the P for company X. For company Y, it is 11, and for company Z, it is 12. So if I ask you, what is the average PE multiple? What is the average PE multiple? 12.5 plus 11 plus 12 divided by 3.
Uh, 11.83.
11.83. 11.83. So average P is 11.83. So if we have a company whose earnings per share is, let's say, 3.5, we know that the average price to earning ratio of the industry is 11.83. So what should be the ideal price of ABC? Can I say it's going to be 11.83 into 3.5? Right? Because on an average, the price to earning ratio, the value of price with regards to earnings, it is 11.83. So that 11.83 into 3.5. This is 41.405.
Yes, sir. 41.405.
41.405. That's the price. That's the price of the share which you can really think of when we have this P multiple approach coming up our way. Okay. Fine. Okay. So here we have now a similar question. Let's look at this question 1 now. Okay, a company has a book value per share of 137.8. So we have book value per share is 137.8. Its return on equity is 15%. Return on equity is going to be 15%. And it follows a policy of retaining 60% of its earnings. So can I say the retention ratio is 60% or 0.6 as a number? If the opportunity cost of capital is 18%, okay, opportunity cost of capital, which is KE, is 18%. Compute the price of the share using dividend growth model and the Walters model. Okay, so Gordon model and Walter model. I just write down both the models. You can simply substitute and get the answer. So Gordon model, the price is going to be calculated as EPS of first year into 1 minus B upon K minus G. Walter model, the price is dividend plus earnings minus dividend, right? Multiplied by R upon K, the whole divided by K. Okay, so just try to calculate these two numbers. Get the get the price as per the Walter and Gordon. Try to get the value as per Gordon and as per the Walter model, guys. What's the value is Gordon and Walter model?
Ninety-one 91.91 as per Gordon model.
Okay, so this is like 20 point. EPS. EPS needs to be get
20.68.
the book value per share is this. Return on equity is 15%. So return on equity, if it is 15%, then it's going to be 137.8
9.
into 15%. That's the EPS
Yes.
into 1 minus B. So retention is 60%. So it's 1 minus 0.4. No, 0.6. 1 minus 0.6 upon K minus G. K is 18%. 0.18 minus G, which is growth rate is
9%.
we'll have to get the growth rate as what B into R, which is 0.6 into
0.15.
Return on investment, opportunity cost of capital. Return on equity is 15%, right? So 0.15, yes. So this is 137.8 into 15%. 137.8 into 15% into 0.4. So 8.268 divided by 0.6 into 0.15. So divide by 0.09. This is 8.268 divided by 0.09. Which is 91.87. Okay. Did we get it?
Yes, sir.
Now, yeah, coming to the Walter model. So Walter may the dividend is going to be, how much is going to be the dividend? 137.8 into 15% is the earnings. Out of that, 0.4 is being paid out. Plus, so let's do one thing over here. Let's compute the earnings and dividend first. So the earnings are 137.8 into 15%. So this is 137.8 into 15%, 20.67. Dividend is going to be earnings into, which is 0.6. B is 0.6. 20.67 into 0.4. Which is 8.27. Okay, so now the price is going to be 8.27 plus 20.67 minus 8.27 into return is 0.15 upon K is 0.18, and then the whole thing divided by 0.18. So what is the price? 20.67 minus 8.27 into 0.15 divided by 0.18. This plus 8.27 and divide by 0.18.
103.35.
103.35. That's the Walter model answer. So that's the price as per Walter model. Okay. Are you done, everyone?
Done, sir.
Yes, sir.
Yes.
Sir, which means KE means under Gordon's model, K minus G. When you are identifying G, with the retention is 60 percentage, upon
Yeah.
which we will put
B into
15
R.
percentage of, yeah.
We will be earning 15% on that, yes.
Okay, sir.
Okay. Fine. So this is done.
Sir, here the which model is good, sir? That Gordon model is saying 91.87. Walter model saying 103.35.
Correct. So different valuation models will have obviously different values. So it's not that one typical value will be acceptable, right? So both the models are likely to give you a different value wise, because of course the things are quite different at both the levels, right? So that's going to be a different number. Okay, it's going to be a different model altogether. It's not at all correct to say that one of them is correct and another is incorrect. Okay, so both of them are right in their own way, because Gordon has got its own disadvantage that you cannot assume the thing to be, the price, the growth rate cannot be assumed to be more than the cost of equity. Okay, so that is going to be there. Then Gordon or Walter, either of them, depending on what value we are seeking, we can definitely approach each one of it. Okay. Okay, fine. So this is what we have done with this. Yeah, so question number 1 is done. We are done with 3. I think we have done with 5th is done, and 6th is also done. Okay. Now, next thing that we have to do is okay, so we have to look at now the next approach that we have to complete. As we have seen, what we have covered till now is we have seen the return concepts, we have seen the valuation of equity shares using dividend-based model, earnings-based model. Now it's time for us to look at the cash flow-based model. Now, cash flow-based model are similar to your earnings and dividend-based model. Essentially, we are simply going to take the present value of cash flows. But what we need to calculate when we want to derive the value is to calculate something called as free cash flow to firm. Free cash flow to the firm. Okay. So which is basically FCFF. Right. So free cash flow to the firm. There are various ways of obtaining the free cash flow for the firm. So you want to know how much free cash flow an entity is having. You start with net income, or you start with your cash flows, or you start with EBIT, right? There are different approaches. So free cash flow for the firm to calculate, we just start with net income. And when we talk of net income, it is profit after tax. Okay, so net income is profit after tax. So free cash flow to the firm is net income, which is profit after tax. To that, you add the interest expense. Okay, so net income. To that, you're going to add the interest expense. Right, so net income plus we add the interest expense, because we are looking at free cash flow for the firm. So for the entity, for the entire entity as a whole, how much cash flow are we receiving? So it's going to be net income plus interest expense into 1 minus T. We make it as a after tax figure into 1 minus T. So it's like the operating cash flow we are talking of, right? So operating cash flow. So we add back the post-tax interest. Then of course, in this, we have got the depreciation, which is a non-cash item. So we also add back the depreciation. Okay. So this cash flow is not something which is freely available with the entity, because the entity is obviously going to get committed to buy certain fixed assets in future, to invest in certain amount of stock in future. So I need to take account of that. So we are going to adjust plus or minus going to do the capital expenditure being added or subtracted, right? So if it's like you're going to buy certain new assets, you're going to sell certain assets, and you know that the net capital expenditure which is planned, that's taken over here. Then we also adjust, add and less the changes in working capital except cash. So whatever is the change that you're expecting in working capital, that's what you're going to consider, right? So I would like to highlight over here that when it comes to capital expenditure, it will be added if fixed asset to be purchased. Sorry, it will be subtracted if fixed asset is going to be purchased, and it's going to be added if fixed asset is to be sold. Same way, changes in the working capital, you can say it's going to be subtracted if working capital is increasing. So if you have an increase in stock, if you have increase in debtors, then there's going to be subtraction. And it's going to be an addition if working capital is going to get reduced. Like if your stock is getting reduced, if your debtors are going to get reduced, then it's a situation wherein the working capital is going to fall, right? So if the working capital is reducing, you're actually getting the cash flows released. If the working capital is rising, you're getting essentially the investing the cash flows into the working capital. So that is one approach of calculating the free cash flow for the firm, which is FCFF, right? Another way to calculate this FCFF is to start with EBIT. You start with earnings before interest and tax, make it an after tax figure by doing it is 1 minus T. Then add back the depreciation. Right? So essentially, when you did the net income plus interest expense into 1 minus T, that is what is EBIT into 1 minus T. So you add back depreciation, then add less your capital expenditure and add less your working capital expenditure, right? Or you can also calculate FCFF by simply taking it as earnings before interest, tax, depreciation and amortization is EBITDA. Make it 1 minus T, right? Add the tax saving due to depreciation, and then the CAPEX and WORKEX adjustment remains the same. So either you start with net income, add net of tax interest expense, or you take EBIT into 1 minus T, add back the depreciation, or you take EBITDA and consider the tax saving on depreciation separately. Okay. One more way of getting this free cash flow for the firm is to take cash flow from operations. This is from cash flow statement, right? And then we just add over here interest expense into 1 minus T, which is post-tax, right? And then add or less the capital expenditure. Because understand, when you're looking at cash flow from operations, you've already accounted for working capital expenditure in this, right? So depending on either of the approach, whichever the approach is available for us, you can pick up any one of this formula. Okay. And then free cash flow for equity. If you want to know what is the free cash flow for equity, we can simply say that it's free cash flow for the firm. From this, you identify what is the interest expense that you need to pay, right? Subtract the principal to be paid, right? Less the preference dividend to be paid, plus the new debt to be raised. So it's like free cash flow for the firm. You subtract whatever interest you're going to pay. You subtract the interest, I mean the principal that you're going to repay, subtract the preference dividend, and also consider the new debt that you're going to raise. Okay, that's a free cash flow for equity shareholders. Okay, so this is something which we're going to work on in the further part. So let's just take a break right now, guys. Break of around 10-15 minutes, and then we'll be back with more discussion on FCFF and also certain numericals on this. Okay, so let's take a break, guys.
Okay, sir.
Yes.
So we were looking at another method to calculate to calculate the value of the company or value of security. That's by calculating FCFF and FCFE. So this is basically going by the nomenclature. It's FCFF means we want to know what's the free cash flow available for the firm as a whole and what's the free cash flow for the equity. Okay, so free cash flow for the firm and free cash flow for the equity. That's what we are really interested in. And of course, the method remains the same, wherein we are supposed to take the present value of all the future cash flows. Okay, so let us understand this with the help of a number, with the help of a question to get the value. Yeah, this question. Let's look at this question number 10. Okay, so here we have the numbers. We have to calculate the value of the share from the following information. So we have profit after tax, we have the equity capital of the company, par value or you can say face value is given to us. Debt ratio is given as debt upon debt plus equity, which is 27%. Long run growth rate of the company is 8%. Beta is 0.1. The risk-free interest rate is 8.7. Market return is 10.3. Capital expenditure per share. So remember, we have been given the CAPEX per share, which is 47. Depreciation per share is going to be 39. And change in working capital is 3.45 per share. So all the numbers are given to us in per share format. Okay. So first, let us look at what's the number of equity shares that we have. So number of equity shares is going to be 1300 being the equity capital of the company, and each of the share are having a par value of 40. Right, so 1300 crores divided by 40, which is essentially 32.5 crores is the number of shares. 32.5 crores is the total number of shares. Okay, then we have to calculate free cash flow for the equity. Okay, so to calculate a free cash flow for the equity, we have seen that it's going to be FCFF, right? Free cash flow for the firm minus interest into 1 minus T, right? Minus interest into 1 minus T. Then you have less principal repaid. Less principal repaid. And further, less preference dividend plus new debt. Less preference dividend plus any new debt that you are raising. Okay, so we can actually expand it and say that free cash flow for the firm is essentially net income. So we start with net income. To that we add interest expense into 1 minus T plus depreciation. So we add plus interest into 1 minus T plus depreciation. Right, and further we adjust the CAPEX and also the WorkX, right? Fine. And then we have this aspect of interest into 1 minus T minus principal repaid minus preference dividend plus the new debt that is raised. Okay, So here we have interest into 1 minus t and interest into 1 minus t getting cancelled. Right? And essentially, this comes out to be what? Net income. You add to it depreciation. Right? Then add less capital expenditure. And then further add less working capital expenditure, less any principal repaid, minus preference dividend, plus the new debt to be raised. Right? So this is your free cash flow for equity. Yeah. So we need it like on a per share basis, right? We simply need it on a per share basis. Okay. So now, since we want to know it on a per share basis, let us talk of earnings per share. Okay. So earnings per share is to be computed as, we have the profit after tax and we also know the number of shares. So earnings per share is going to be 290 as the income divided by number of equity shares is 32.5.
.91.
So 290 divided by 32.5, 8.923. Yeah. So we add depreciation to this. Now, how much is the depreciation per share given? 39. Depreciation per share is 39. Less capital expenditure on a per share basis. Capital expenditure on a per share basis is 47. Okay. Then less working capital expenditure or changes in working capital, we have 3.45 per share. So 3.45 per share is getting subtracted. Then, so workex is done. Any principal repayment is nothing specified in this part. No principal repayment part. Any preference dividend, nothing. But new debt is something, yes, that's going to be there. So we say, let's add the new debt that we are going to raise on a per share basis. Okay, so new debt on a per share basis is going to be added. Okay, new debt on a per share basis. Now, how do we get this new debt on a per share basis? Let's do a separate calculation for that. New debt raised. So first we'll talk of what is a change in non-current asset. Because you see, non-current asset is basically change. You can see the capital expenditure is 47, and the depreciation is 39. So essentially, change that is happening in the non-current asset, right? So you're having an expenditure of 47 and there's a depre of 39, right? So net change that you're observing in the non-current asset is 8, right? And also you have a change in current assets happening to the tune of 3.45. So your non-current assets or the fixed asset is going to change by 8 and current asset is going to change by 3.45. So total change that we have is 11.45, right? So we simply have total additional funds to be invested, total additional funds to be invested is 11.45. Okay. And out of this 11.45, what portion is going to be funded by debt? You can see it's specified debt ratio of the company, which is debt upon debt plus equity, or the total proportion of the funds that is provided by debt is 27%.
27.
So we'll say funded by debt is 27%. So what will be the amount of debt to be raised? Amount of debt to be raised will be 11.45 into 27%. How much is this? 11.45 into 27%, 3.09. 3.0915, you can say, yeah. So that is the new debt that we are going to get on a per share basis, which is 3.0915. Right. So that will essentially give us the free cash flow for equity on a per share basis. Free cash flow for equity on a per share basis. Yeah. So can you just calculate and tell me what is the free cash flow for equity on a per share basis over here? What's the free cash flow for equity on a per share basis? Yep.
Point 5645.
0.5645. So 0.5645. That's the free cash flow for equity on a per share basis. Now I have
Yes,
to
sir.
take the present value of this by using the same Gordon formula. For that, I need certain numbers. Like I need the K. So for that K, I need risk-free rate. I need the value of beta. Right? I need the risk-free rates. I'll need the value of beta. I'll need the value of RM. Right? So beta is 0.1. The risk-free interest rate is 8.7%. Risk-free rate is 8.7%. Beta is 0.1. And market rate of return is 10.3%. Okay. So what will be the KE over here? KE will be RF plus beta into
RM minus RF.
RM minus RF. So RF is 8.7% plus beta is 0.1 into RM is 10.3% minus 8.7%. So 0.1 into 10.3%. Sorry, we need to take the difference first. 10.3% minus 8.7%. Or say it's 10.3 minus 8.7, which is 1.6 into 0.1 plus 8.7, which is 8.86%, right? So
Yes, sir.
8.86.
8.86.
8.86. What's the growth rate given in the question? Growth rate, long run growth rate of the company is 8%. Long run growth rate of the company is 8%, right? Then we can get the price of the share today by simply looking at free cash flow for equity into 1 plus G upon K minus G. So free cash flow for equity is 0.5646 into 1.08 upon K minus G is 0.0886 minus 0.08. Yeah, so what's the price? What is the price? Yep.
$70.89.
Yes, sir. 70.90.
70.90. Right? Are we getting these numbers?
Yes, sir.
Right? Okay, fine. So with that, let me just do one thing. Let me just share certain MCQs with you for discussion. Let me just share the screen with the MCQs. Okay. Okay. Can you see the questions, guys? MCQ questions?
Yes, sir. Visible, sir.
Visible? Okay. So let's look at the first question. Which of the following methods is primarily used in valuing a company based on its future dividend payments? Pretty easy MCQ, guys.
Dividend discount model.
It's going to be dividend discount model because as the name says, it's future dividend. You obviously consider the dividend discount model. Okay. So the second one, in the dividend discount model, the value of the stock is most sensitive to the expected dividend growth rate, current dividend amount, the company's book value, or the historical dividend payout.
Dividend growth rate.
Model, which is the most sensitive number?
Dividend growth rate.
The expected dividend growth rate.
Because we know P0 is D1. So D1 is nothing but D0 into 1 plus G, right? And divided by KE minus G. So you can see G is an important number over here. As you change the G, the numerator and denominator both are going to get affected. And a small change in G is going to have a drastic effect in the denominator, due to which the P0 is going to be most sensitive. So of course, the expected dividend growth rate is the accurate answer, right? So you can say it's obviously the expected dividend growth rate, which is the most sensitive one. Okay. Over here, it was the dividend discount model. Okay, then third one. Which of the following is not a limitation of price to earning ratio in equity valuation? Yep.
It ignores the future growth prospects. Ignores future growth prospects.
Ignores future growth prospects. Yes. In price to earning ratio, we don't consider anything about the, the future growth rate that is expected in the company, right? So therefore, it ignores the future growth prospects. Absolutely correct. So it ignores the future growth prospects. Okay. What is the answer for question 4?
Cost of equity.
Sorry.
Cost
Cost of equity.
of equity.
Cost of
Equity.
equal rate of return is also known as the cost of equity. Absolutely correct. Okay. What about question 5? What a question 5 is? What's the correct answer for question 5?
$88.33.
88.33.
83.33, sir. B.
83.33.
83.33.
83.33.
83.33, everyone?
Yes, sir.
Yes. Okay.
Still,
Then, sorry.
सर इसमें जैसे कहीं पे हम डिविडेंड 1+G ले रहे हैं, कहीं पे ओनली डिविडेंड ले रहे हैं. अगर इसमें 1+G ले रहे हैं तो आंसर गलत हो रहा है.
No,
ऐसा
it has a current
पता लगे
dividend of
हमें
5.
1+G लेना है या नहीं लेना.
So if
Okay,
it's a current,
student, I will explain you. Okay, don't worry. Jagbandhuji, you have considered it as a how you have considered it this question?
it's current dividends. It is taken to be D1.
Okay. But the
Current year dividend, which will be paid at the end.
1 second. Current year dividend, it will be paid at the. Okay. No, doubt of the student is correct because like generally what we do, we use the term dividend paid and dividend expected. Actually, so dividend paid is generally considered as D0.
Correct.
Okay, and dividend expected is considered as D1.
D1, yes.
Okay, generally current dividend, in as per my opinion, generally sometimes convey a different meaning. It conveys.
Sorry, current dividend is D0, sir. My bad. It is D0.
Okay,
Taken it to be D0.
So otherwise you take it as a D0, only then it will be to some extent correct. And simple student, please note that if in the question simple dividend has been given, so then in that case two answer will be possible and we will consider them. Okay, sometime if dividend simple has been mentioned, so either you can consider as a D0 or D1, both will be considered. So don't worry about that part.
Okay, sir. Okay, sir. Thank you, sir.
Jagbandhuji, please continue.
Yeah. So, yeah, guys. So this is a practice question. Question number 6 for you. It's a 2-stage dividend model thing. So, can we just do it quickly? What would be the answer for this? 6th question.
So it's 82.62.
82.62. Is it? So first year dividend is at 4.6 because it has just paid a dividend of 4. So this means the dividend one will be 4.6. Second year dividend is 5.29. Correct? Just check the dividend numbers. Third year dividend is 6.08. And fourth year dividend is 6.45. Correct? Let's verify these dividend numbers, guys.
Okay, so it's my mistake. I put that the rate of return is 15% instead of 12%.
No,
That's what
rate of return is 12%.
Yes, that's what. That's 89.15 is right, sir.
Okay. So this is 89.15 because you get the price of the share in year 3 or value of the share in year 3 is 107. And then you simply take the discounted value of all the cash flows. Okay. So with that, we are towards the end of our session today. We have covered like equity valuation to a great extent. Few concepts are still pending. Probably we'll be taking that up in the next session. And obviously next session we'll be doing with one of the part of our topic, which is the equity valuation. And post that we'll go ahead with the bond valuation and bond mathematics. Okay. So any queries, guys, you can just raise it now, or else we can just call it a day.
Jagbandhuji, have you seen the query handle? If please check this.
Yeah, it was. There's no query, I think. That is, they have interacted with me during the class. That's it.
Okay, Geet Chauhan, na? So please.
Yeah. She has even messaged on the chat also.
Okay. Okay, so just take care of this. So sometimes student may also Geet Chauhan, I think he was using this.
Yeah. No, they have interacted during the session, so I had a look at it earlier.
No problem. Okay. Okay. Thank you, student, for your patience in listening, and thank you, Jagbandhu sir, for your sparing precious time and enlightening the student on this topic. Student, as I told you in last class, that one part was security analysis. Now we have started with the second chapter of this section, that is security valuation, and we have started with the equity valuation. So this topic will be further continued in the coming classes. So meanwhile, you can prepare yourself what I have discussed in these classes. Jagbandhuji, just share my our landline number as well as email ID.
It's not there over here. I'll just
Okay,
write
no
it.
problem. Just write it down.
Yeah.
0120 3045 956.
956 or 959, sir?
956. Maybe I mistakenly written 959 anytime.
Yeah, I think last time in 959 it was written. I noted that. Or otherwise, I mistakenly write as 9 instead of 6.
Because 956 is my extension number is so much embedded in my mind. It is so much recorded in my mind. Even in the night, if you ask me my extension number, okay.
Right, sir. I think
I will have to check again my lecture. SFM-final @ICAI.in.
this is right.
In one class, in earlier batch, I think 2 years back, in one when I was to the faculty, I was getting them. It was I think myself was writing this SFM-final. I mistakenly written as SFM-final@gmail.com, but it can be a mistake. Okay, but extension is quite impossible. Okay, anyway, student, thank you very much for such an interactive section, and see you in the next class. Yes. Sanjay, you want to say something? Okay.
Not me.
Okay. Sorry. Okay, thank you. Okay, have a nice day. Thank you. Okay, Dakunji, thank you very much.
Thank you, sir. Thanks.
Thank you. हाँ, देख लेते हैं, बस कोई चैट में कुछ है तो नहीं, ठीक है, ओके।